World markets endured a lot of volatility last year. On a trading day, markets could be significantly higher, only to give up these gains through the course of the next few days. The result is frustration and confusion, and investors shunned markets. How well did the South African markets fare in the midst of all of this drama? Gentlemen, welcome to the program. Thank you so very much for joining us. 2011 wasn't such a bad year for the JSE All Share. I mean, at one point we were down slightly, but ending the year off up around 2.6%. Kobie, over to you. Were you happy with the returns that we saw?
Yeah, I mean, I think relative to what you could see on a global scale, Eleni, I think markets in South Africa actually held up quite nicely. It was the volatility that really killed the investor during the year. Just look at your screen.
But not the trader, though. I'm sure the traders enjoyed that volatility.
No, absolutely. I mean, if you're a trader, you would have loved this kind of volatility. But if you're a long-term investor, as you said in the intro, you know, the one day you were making money and the next day you were actually giving up most of those gains. And the intraday volatility was just absolutely massive. But let's just look at the total picture. If you look at your screen now, you'll see the all-share index, and what I've done over here is I've invested 100 Rand in the beginning of the year, and you can see the volatility during the year with the low point in the market kind of being attained there in August during the year. You see a run up again. You can just see the volatility, absolutely massive volatility, and there you can see the return for the market up 2.6%, just slightly ahead of the initial 100 Rands that you've put into the market. If you just carry on looking at your screen, I've now showing the all-share index relative to some international markets, the S&P 500 in red, the UK's FTSE 100 in green, and Hong Kong in purple. And those are on home currency terms. So we're not looking at it specifically in South African rands. Once we bring the currency into consideration, that'll obviously muddle up the numbers even further. Just from a home currency perspective, what has been your experience? And you can see South Africa's actually held up quite nicely. There's a South African return there where the pointer is. America, slightly, maybe slight negative return. You can see the UK, for every £100 you put into the market, you're probably worth about £98. And then in Hong Kong, for every 100 Hong Kong dollars you put into the market, that would be worth about 80 Hong Kong dollars. So certainly from an emerging market perspective, from a South African perspective, you're certainly, I mean, in a very different situation.
Absolutely. Roland, over to you. Looking at the returns, I mean, 2010 was a far better year, but we didn't have all the negativity and volatility with regards to especially what we saw on the Eurozone front. That said, we have done quite better than the S&P 500, the FTSE and the Hong Kong, as Kobie just alluded to. Overall, the volatility, did you use it in your favor? Or do you feel that investors just had a bad year?
I think it was an emerging market year last year relative to developed markets. So I think the South African market was buoyed by the rest of emerging markets. But I do have to add that if you include the Rand's effect, because the Rand was down 20% or 30% over the period, those returns would have looked a lot worse for foreign investors. So I think in emerging market terms, South Africa didn't do that well. But relative to developed markets, certainly. As a domestic investor, you would have done quite well. I think from a volatility perspective, we saw since the subprime crisis in 2008, volatility ramp up. It actually peaked in about September of 2010, and it's been coming off since then. And in August last year, volatility started picking up again. At the moment, the Aussie's volatility is around 14%, which is actually below its long-term average of 17%. So we're actually in a relatively low volatility environment right now.
Yeah, I want to say what Roland has said during the course of the whole of last year, and that it has been a beta-focused market rather than an alpha-focused market. So from a price-to-earnings perspective, you've kind of seen this convergence as far as price-to-earnings ratios are concerned, with no massive outliers, and hence the ability for active managers to add incrementally to returns beyond the benchmark has been quite tough. But that said, you've seen a market that stayed kind of flat for the year. If you've been invested for the whole year, you've had a return of 2.6% if you've owned the market, obviously.
Kobie, I mean, the big question is, why did South African markets fare better than the developed world? And we know that, we have to look at the macro picture, but at the end of the day, we have to look at fundamental factors as well with regards to earnings. South African earnings looking quite good, but so too are earnings coming through from the developed nations. Do you think that they would probably be offering more value right now relative to what we see on the South African equity front?
I mean, from a 2012 perspective, I think that just from a starting valuation perspective, I think that international equities are providing better opportunities than South African equities, and potentially emerging market equities are concerned. But that obviously can, potentially obviously be influenced by what the earnings picture looks like in 2012 and how robust that earnings picture is looking at the moment. The thing that gets me about markets, though, is the fact that sentiment is just so negative at this stage. Sentiment is immensely negative and continues to be so. And it's kind of this huge kind of focus around the Eurozone and how terrible the Eurozone has been, What I usually find helps in situations like this is to kind of take a return for a year and to put it into kind of context, and relative to other returns. If you look at your screen now, you'll see the returns. And what I've done over here is I've looked at calendar year returns over the last half a century or so. And what I've done is I've bucketed them into what I call a frequency graph. And there you can see it. Now let me just quickly show you how it works. Returns generally were up between 40 and 60% in all of these following years that you see over there. So in 2006, and 2005, and 1993, and so forth. If you want to see for the calendar years that markets were up between 10 and 20%, you'd see it's for most of those years that you see over there. So let me highlight for you potentially the last 4 years and how those have looked. And there you can see those in red. We started 2008 when the market was down between minus 20 and minus 30%. We then moved to 2009 when the market was up 30 to 40%, which is a fantastic return. And in 2010, when the market was up between 10 and 20, and there's 2011. In 2011, the market was only up by 2.6%. So kind of slap bang kind of in the middle. The interesting thing is the last time around, we saw markets as much down as what they were in 2008. That was in 1970. And let me highlight 1970 and the subsequent years in 1970 for you as well. You can see those on your screen in orange. You can see 1970, the market down minus 20 to minus 30%. 71 and 73 being average years, and 1972 being a fantastic year. We haven't actually seen a year like 1972 in the market over the last 5 years, which is obviously one needs to take into consideration as well. Putting those together and then kind of loosely fitting a distribution curve to those, that is what the picture looks like then. And a distribution curve basically just takes into consideration all the data points and where the majority of the data points happen, and kind of that's where the bubble kind of invariably happens in your distribution curve. Eleni, just have a look at the market here. Between 40 and 60%. You see how often markets are up between 40 and 60%? Yeah. That's amazing.
Absolutely.
Markets are more up than they're down.
Markets out of the 50 years, only 13 years experienced negative returns.
Yeah.
So that's a good ratio to look at. But looking at the trend, Roland, would you say that in 2011 we should have actually had a much stronger year? Because I've noticed in 1971 we also saw similar returns, below 10%, and we saw the big drop in 1970. So are we pretty much in line with the overall trend?
I think we have to look at the macro picture here, because if we're going to compare across periods, we have to also sort of try and compare business cycles or economic periods. In the 70s, we had a bit of an oil crisis, so we had a very high inflation, and to a large extent, oil is currently quite high, and inflation is feared to start rising above expectations or continue to rise outside the band that is targeted in South Africa by the authorities. But when it comes to the returns this year, I think you said, could we have done better? It was your question. I think if we look at the PE ratio in our market, at the beginning of this year, the PE ratio was at about 18, at the beginning of last year, was about 18. Which was quite high. So we really did well post the subprime crisis as an emerging market.
And then we reverted back to around 14 or so.
And we're now at 13. So we're actually below, or we're actually at fair value now. The long-term PE for the market is about 13. So the market is fairly valued now. So it basically came from an expensive position to fair value. So where is it going to go from here? It'll probably go up a little bit this year, but we're not going to expect huge returns going forward.
What's fascinating is that we're very close to that all-time high from a numbers perspective. I mean, we're sitting at above 33,000. Who knows what the market is doing today, but at the end of the day, we're very close to that all-time high. Does that mean anything? Because we hit that in March 2008. The PE is at a very different level right now. As Roland said, we are sitting at fair value.
Valuations mean everything to me. The actual level of the market means very little to me. I don't know what you feel, Roland. I mean, the fact that
technical analysts would love to look at the levels and their psychological sort of support levels and resistance levels. So a technical analyst might get a bit more bearish now, saying that the market has run up to its previous peak peak, and it'll have to break through that before it can carry on. I think I do also agree a bit that levels aren't as important as the
what actual
fundamentals.
valuation is. I mean, talking about price to earnings ratios, I mean, that's why, kind of understanding markets, about cheap markets and getting kind of returns out of them, I think we've done fantastically well. The risk at the beginning of 2011 was the fact that you could now have, because of the 18p that you started the year with, the risk was that you were going to actually get a negative return out of the out of the market. And luckily, earnings were obviously quite nicely up. Let me show you some earnings. Let's bring you into the picture, and let's maybe just have a look at the earnings picture as far as the Aussie is concerned. Again, exactly the same graph we're going to be utilizing, and exactly the same distribution curve that you see at the bottom end over there, and you can see how earnings look for the market. Let's fit 2008 onto the picture there, 2008, 9, 10, and 11. And just look at 2009. Look how much earnings were down in 2009, between minus 20 and minus 30%. You, in essence, rewrote the last half a century's textbooks on how bad markets can perform from an earnings perspective, not from a price perspective, but certainly from an earnings perspective. And let me just show you 1970, just maybe before we go there, but just have a look at 2011 there. Earnings up 30 to 40%.
There is a base effect embedded in that because it's a sort of rolling kind of concept, earnings growth. So there's a bit of a kicker from the low growth we saw in 2009.
I suppose the risk, Roland, is the fact that if you in 2011 had earnings that were only up by 10%, and starting the year off an 18p, you potentially could have had a negative year. Whereas, the fact that earnings are up by that much, meant that you had a flat year. Let me quickly fit 1970 to the argument over there. You can see far more kind of narrow distribution as far as earnings are concerned, and let me fit the distribution curve to that, and you can see kind of how that looks. Very, very different to the actual returns picture in the market. Earnings are far more concentrated.
And it's quite easy to be pessimistic during tough times, but looking at the half century, out of the 50 years, only 7 we experienced a negative earnings growth.
Yeah, absolutely.
So would you say that relative to the earnings that we have been seeing, shouldn't we be sitting at a higher PE?
Well, I think most of the market analysts, including myself, probably see this year quite average in terms of earnings growth. So anywhere between 15% is sort of probably the median, or even maybe a bit higher, 20%. But that's where it starts getting thin in terms of forecast. So it's a pretty average year in terms of earnings.
Right, we're going to go to a very short break. When we come back, we speak more on the returns of 2011. Don't go anywhere.